Hello. Welcome to our next chapter. So we are doing this from our audit in 100-page notes. So today we will be doing audit of CFA, that is a consolidated financial statements. This has been coming for 5 marks in each attempt. So definitely do this chapter. Average is about 4 marks in the since when the new syllabus has come. And as usual, I have again made the mnemonics for these chapters also. And this PDF I will be uploading on the Telegram, the mnemonics PDF. So again, we have all our mnemonics that are our entire chapter is covered in 2 pages. So all the points will be covered in this. Okay, so as and when required, we will keep coming to this mnemonics to learn. Okay, so starting with this chapter, that is audit of CFS. This is approximately 30 pages in your ICA study material, which I have put in approximately 5 pages. So now your CFS improves. Now, when we say consolidated financial statements, what do you mean by consolidated financial statements? So what you have to understand, first of all, your CFS includes your consolidated balance sheet, then is your consolidated P&L, third is your consolidated cash flow statement, fourth is your consolidated any changes in equity, and fifth is all explanatory notes and that are attached with the CFS. So all of this becomes part of your CFS. So first is your balance sheet, then there is your P&L, then there is your cash flow statement, then there's changes in equity, and then there is your explanatory notes. Okay, now consolidation of financial statements is mandatory under Companies Act. So for some companies, consolidation is mandatory. So first is company with one or more subsidiaries, including your AC and your joint venture, that is your associate or your joint venture, in addition to its own financial statement, prepare a consolidated financial statements of the company and all of the subsidiaries. This is as per section 129 subsection 3 of the Companies Act 2013. So a company with one or more subsidiaries, including your associate company or your joint venture, it shall also prepare your CFS with section 129 subsection 3 of Companies Act 2013. Next, CFS shall also be approved by the BOD before they are signed on behalf of the board. So CFS shall be approved by the board of directors. The consolidated financial statement shall be approved by the board of directors before they are signed on behalf of the board, along with your standalone financial statements, and shall also be laid. Even the reports are being laid, but you are not. Are all laid at the AGM of the company along with the SFS, that is your annual general meeting. So this should also be kept at. This should also be laid at the AGM. Next, if required to prepare CFS under your accounting standards. So if the AS specifies that boss, you are required to prepare CFS. CFS shall be made as per provisions of Schedule 3 plus your accounting standard. If not required to prepare CFS under AS, that means as per your accounting standard, if you are not required to prepare CFS, in such a case, it shall be sufficient if the company complies with provisions of CFS provided in Schedule 3 of the Act. So over here it is Schedule 3 and AS both. Over here it is only Schedule 3. Okay, now there are certain companies who are not required to prepare CSF. So all conditions have to be satisfied. That means you do not have to prepare CFS even if you satisfy these conditions. That means you have your associate, joint venture, subsidiary, etc. But you will be exempt if, first of all, if it is a wholly or a partially owned subsidiary, so either 100% or less than 100% owned subsidiary of another company, and all its members having been intimated in writing do not object to the company not presenting CFS. That means the members of the company, they do not have any problem with the company not presenting any consolidated financial statement. So this has to be intimated in writing. That means you have to tell the members in writing that boss, we are not making a CFS, and I hope you are okay with it. You don't have any issue with it. So do not object to the company not presenting CFS. Second condition that has to be satisfied, its securities are not listed. They are not listed neither in the process of listing, not in the process of listing of any stock exchange, either in or outside India, does not matter. So you should not be listed today. You should not be listed in the future, either in India or outside India. And third, it says its ultimate or any intermediate holding company. So either its ultimate. So for example, there is a company 1, there is a company 2, 3, and there is another company 4. Now 1 is subsidiary of 2, 2 is subsidiary of 3, 3 is subsidiary of 4. So in such a case, for company 1, its ultimate holding is 4, but your 3 and 2 are intermediate subsidiaries. So either it's ultimate or intermediate holding company. So for 1, your 2 and 3 are intermediate holding companies, whereas your 4 is your ultimate holding company. So it's either its ultimate or any intermediate holding company files CFS with the registrar. So that means if you are not making any consolidated financial statements, at least some parent, either ultimate or intermediate parents, at least someone is making CFS. So only and only if these three conditions are satisfied, only and only if these three conditions are satisfied, will we allow you to not make a CFS. Okay, so I have also made a key for this. So that is your companies which are not required to prepare CSF. So your key is your MILF, that is MILF. Okay, so the key that I made. So now all the keys in this chapter will be beach themed. Okay, so everything will be related to beach. So that your keys don't mix between different chapters. If you are looking for other chapters, I have uploaded the mnemonics on the Telegram channel, or you can look at the YouTube videos, whatever is convenient. Okay, so this is your mom is looking fantastic. So if first condition is members shall not object. Second is it should not be an investment entity whose subsidiaries are valued at FVT PNL. So we will cover this point. I know I skipped this point, so we will cover this point. We will discuss it. Next is it should not be listed, and last is the holding company file CFS. That means either your intermediate holding or your ultimate holding file CFS. Okay, so this is your key, that is your MIL. Okay, let's go to our okay, and then investment entities. This was the point with I that I had not uh, explained you. So the investment entity need not present CFS if it is required to measure all of its subsidiaries at FVT PNL, that is your fair value through PNL. So if you are doing FR, of course you will be doing FR. If you are doing audit, so of course if your subsidiaries are measured at FPT PNL, then the investment entity need not prepare a CFS. Now you have to understand what is an investment entity. So now an investment entity, it obtains funds from one or more investors for providing them investment management services. That means you are taking funds from a lot of people and providing them that I will manage your fund. That is your investment management services. Its business purpose is to invest funds solely for returns from capital, appreciation, and investment income. That is, this is your main source of income, and measures and evaluates performance of substantially all its investments on a fair value basis. That means it measures all its assets, all its investments at your fair value basis. So in these four conditions, your CFS is not prepared. It is still okay. Now next is your responsibility of parent. So what are the responsibilities of parent? So first we'll understand the points and then we'll do the key. So identify components and financial information of the components to be included in CFS. That means which component, which entity do I have to include in my CFS? That is your point number 1. Next is identify reportable segments for segment reporting. I hope all of you all remember that is your in FR it is I think 108. So you have to identify reportable segment, that is which segments are my reporting segments. Next, obtain complete financial information from component. This is the responsibility of the parent. They cannot say that my component did not give me proper information. This is the responsibility of parent that they get the complete information. Harmonization of accounting policies and accounting framework. So now your constituent, your other these other components might be using some different accounting policy, some different accounting framework, and you are using some different accounting policies and framework. Now, in such a case, if you just as it is, just combine them, you consolidate them, it will not make sense because some financial statements are using other accounting policy while yours are using another accounting policy. So therefore, you will have to harmonize both. You will have to harmonize both these financial statements into a single accounting policy and accounting framework so that the consolidated financial statements all have a unique policy, that is only one policy and one accounting framework. So that is what they mean by harmonizing. Next is any gap conversions where applicable. So these are when there are different gaps being followed. So whenever you have to convert, you have to check that it is done properly. Next is identify related parties and related party transactions. First, you have to identify which are my related parties. Then you have to identify which are my related party transactions, because these you will require while disclosure. And next is make consolidation adjustments. You will have to eliminate any intercompany profits, any intercompany losses, etc., etc. All of that come under your consolidation adjustments. Okay, so let's see what key I made for this. Of course, it will be your beach themed only. Mm, So now your key for responsibility of parent. Responsibility of parents key is go chill at the beach, which out of which you will only be using gochi. Okay, so it is go chill at the beach, but you are using only gochi. Now your G stands for gap conversion. O stands for obtaining financial information. T stands for consolidation adjustments. H stands for harmonization accounting policy. Your I stands for identify components, identify reportable segments, and identify related parties. So basically, your three I's and your GOCH. So your G stands for gap conversion. Your O stands for obtaining financial information. Your C stands for consolidation of adjustments. H stands for harmonization accounting policy. Then there are identify. Which are the three identify? Identify components, identify reportable segments, and identify related parties. Okay, so this is your Gochi. Okay, now coming to your third part, that is so what is the responsibility of the auditor of a consolidated financial statement? So if you are the auditor of CFS, what are your responsibilities? So first is validate requirement for preparation of CFS. That is, you have to check that whether do they have to make a CFS or not for the company as per the applicable financial reporting framework. Next, satisfy himself that CFS has been prepared as per the applicable financial reporting framework. He has to check that the financial reporting framework that is applicable to them, whether the consolidated financial statements have been made as per that framework or not. Enable himself to express an opinion. This is your auditor's this is your ultimate objective, that is to express an opinion on the true and fair view presented by the consolidated financial statements. Next, inquire into the matters as specified in section 143(1) of the Companies Act 2013. So there are some matters specified under section 143(1) which he shall inquire. Next, report on matters given in clauses A to I of section 143(3). So remember, over here it is section 143(1). Over here it is section 143(3) clause A to I. So A to I 143 of the Companies Act 2013. Okay, so these are your responsibilities of the auditor. We'll go to the key later. First, we'll finish this box, then we'll go to the key. So, auditor, while conducting the audit of CFS, is expected to, that is, what should the auditor do? So, first is plan their work to enable them to conduct an effective audit in an efficient and timely manner. Effective means you should, whatever is your objective, that should be achieved. Efficient means with minimum input, you should get maximum output. And of course, that is your timely manner. So first is your plan their work. Now second is understanding the accounting and internal control system, because if you do not understand what the accounting system is, where the entry flows, or what my internal control system is, what all my internal controls are in place, you will not be able to do an effective audit. So sufficient to plan the audit and determine the nature, timing, and extent of his audit procedures would help the auditors to develop an effective audit approach. Only and only when you understand this will you be able to develop a proper approach. Use professional judgment to assess audit risk and design audit procedures to ensure that risk is reduced to an acceptable level. So you have to use your professional judgment to assess audit risk and design audit procedures. So first you have to assess audit risk, then you have to design audit procedures. Why? To reduce risk to an acceptable level. You will never be able to bring the risk to zero. It will only be to an acceptable level. Okay. Now coming to the keys of this part, that is responsibility of the auditor of CFS. So over here the key is SCERF. SCERF means surfing can energize real friends. So suppose you have gone on a trip to Goa. Now your responsibility that everybody has fun. Your responsibility is that everybody has fun. So you take them for surfing. So therefore surfing can energize real friends. So S stands for section 143 1. C stands for clauses A to I of section 143 3. So both your 143 are in the first point only. One is section 143 1. Then is clauses A to I 143 3. Then is E, that is express an opinion. R stands for requirement of preparation of CFS. If you remember, this was our point number 1. And last is prepared as per applicable financial reporting framework. Okay, so surfing can energize real friends. It is your responsibility to take your friends for surfing. So surfing can energize real friends. Section. First two are sections. Okay, then with E was your express an opinion. With R, it was requirement for preparation of CFS. That was your point number 1. And with F is your financial reporting framework, that is prepared as per applicable financial reporting framework. Hmm. Perfect. So next is your audit considerations. So the following features of CFS have an impact on the related audit procedure. So if your CFS has some features, it will of course it will impact based on what audit procedures you do. So first of all, the CFS are prepared on the basis of separate financial statements of the parent and component using the consolidated procedures prescribed by AS under the applicable financial reporting framework. That is, SFS of parent has taken, SFS of your component has been taken, and both of them have been combined as per your AS. Second, the auditor of CFS may use the work of other auditor. The auditor of your consolidated financial statements may use work of other auditors as per requirement on standards on auditing, unless the auditor of CFS is the auditor of other components of the group. That means he himself is the auditor of the other components as well. Otherwise, he can use work of other auditor. Okay, your principal auditor, if he decides to use work of another auditor, if your principal auditor decides to use work of another auditor in relation to the audit of CFS, he should comply with the requirements of SA 600. Okay. Now, next is your materiality while conducting audit of CFS. Your materiality. So, materiality should be determined for group as a whole. This materiality used to assess the appropriateness of the consolidation adjustments made by the management while they are preparing the CFS. So they have to check that materiality should be grouped as a whole so that the appropriateness of consolidation adjustments you can assess. Next, can also use materiality computed on group level to determine whether the component financial statements are material or not to the group. Now, what if your component is so small and your entire group is this big? So now this so small financial statement may not even be material. So therefore, this materiality you can also use to check whether my component financial statements are material and whether to use work of other auditor or you can skip it. Next, the principal auditor also computes materiality for each component and communicates to the component auditor. Component auditor means, for example, you have different subsidiaries. For example, you have 10 subsidiaries. So what does the principal auditor do? He computes materiality for each component. That means he will compute materiality for each of those 10 components and communicate to the component auditor. That means the auditor of those components, if he believes is required for true and fair view on CFS. That means if he feels that it is required for your consolidated financial statement, then he will determine materiality component wise. The principal auditor also has to obtain confirmation from component auditor like independence, code of ethics, certain information required for consolidation, and your disclosure requirements. All of this he will be taking from your component auditor. Okay, so now let's see what key we have made for this. The key is, again, of course, it will be beach related. So your key is materiality while conducting audit of CFS. Your key is GOCC, that is GOC. Now, gulls often circle coastline. Gulls are your birds. So they often circle coastline. Coastline is around your beach. So gulls often circle coastline. That is G is group as a whole. Materiality will be group as a whole. Then O is obtain confirmation from component auditor about what about your independence, code of ethics, etc., etc. Then you have to check whether the component financial statements are material or not, and then you have to check communicate to component auditor. Okay, when you have to determine materiality for each component. Okay, so that is your GOCC, that is materiality while conducting audit of CFS. Okay, so that is your gulls often circle coastline. Gulls often circle coastline. Gulls often circle coastline. Okay, coming to your next part. Are your audit considerations. So certain audit considerations to plan his work to enable him to conduct an effective audit in an efficient manner. That is, how should he plan his work? So first is understanding of the group structure and group-wide controls, including assessment of your IT system. So first he has to understand the structure and what controls are there. Second, understanding of accounting policies of the parent and component as well as of the consolidation process, including process of translation of financial statements of foreign component, because you will have to translate those, of course. So therefore, understand the accounting policy of the parent and component, accounting policy of both parent and component, as well as the consolidation process. Okay. Then third, determine and programming the nature, timing, and extent of audit procedures to be performed based on the assessment of risk of material misstatement, that is called your ROMM. So based on the assessment of risk of material misstatement in consolidation process, that is your first you will determine and program, that is what nature, time and extent of audit procedures to be performed based on the risk of material misstatement that you have assessed. Next, determine the extent of use of work of other auditor. Of course, you will have to check that how much help should I take from another auditor, how much should I use another auditor's work. And last is coordinating the work to be performed. Of course, you will have to coordinate, otherwise this will lead to duplication of efforts. Okay, so let's see the key what we made for this. Hmm. So conducting an effective audit in an efficient manner. So if you want to be effective, if you want to be efficient, you will also have to party a little. So your key is your Goa nightclub, that is GOANC. So to be effective and to be efficient, you will have to party a little. So your Goa nightclub. G stands for group structure, understand that you will have to understand the structure. O stands for other auditors. O stands for other auditors work, use, extend. That means till how to what extent will you use the other auditors work. A stands for accounting policies, also you will have to understand. N stands for your nature, timing and extent based on your ROM, risk of material misstatement. And last is your coordinating. Okay, so Goa nightclub, that is GOANC. Okay, now coming to your next part is your considerations with regards to auditor. To verify that all components have been included in CFS, he has to check that the management that has made the consolidated financial statement, whether they have included everybody that should have been included or have they skipped someone. So therefore, the auditor will have to verify this. So first, how will he verify this? He will review his working papers for prior years for the known component. That means if a component was included in previous year, it should also be included in current year, unless there have been certain changes. We have either sold it or we do not own a majority percentage, either way. So you will check your working papers of previous year. Next, review the parents' procedures for identification of various components. You will understand that boss, how are you identify? You understand the parents' procedure, that boss, how do you identify who has to be consolidated and who has to be not. Next, make inquiries of the management to identify any new components. You have to ask them that boss, have you acquired anything? Do you have more than 50% stake in any other company right now? Did you have you done it anything during this year to purchase something? So you'll have to inquire them. Review the investments of parent and components to determine shareholding in other entities. You do not have to just check the investment of the parent, because your parent might invest in the share capital of some companies, but your components might also invest in another company. Then you will have to consolidate them. So therefore, you have to check investments of both parent and component to determine the shareholding in other entities. Next is review the joint ventures and joint arrangements, because these will also be consolidated. Then is review the other arrangements entered into the parent that have not been included in the CFS. So if you see any other arrangement that have not been entered in CFS, that means they have not been consolidated. So you have to check those. Okay, so let's see what key we have made for this. So verify whether all components have been included in CFS or not. Okay, so that is your platypus peri is jumping in ocean. If you remember, platypus peri is from Phineas and Ferb. So to check whether all components have been included, so you know Platypus peri was also a very important part of the show. So you have to check whether all components, whether all characters of the show are there or not. So whenever you see whether all components have been included, you have to remember Phineas and Ferb Platypus peri. So Platypus peri is jumping in ocean. That is PPIJIO. PPIJIO. Okay. So your PP is prior year of working papers. Okay, prior year working papers. Next P is your parents procedure. You understand the parents procedures. Your I is inquiries of the management where you ask them. Then your J is over here, it should be PPIJIO. Okay, so I've missed this. Instead of PPJIO, this should be PPIJIO. To review the joint ventures, review investments, and review any other arrangement. This is your PPIJIO. PPIJIO. Platypus peri is jumping in ocean. Okay. Now next is your reasons. So any reasons for exclusion of a subsidiary, associate, or joint venture. So the at some in some instances it might be possible that we have not included them in our consolidated financial statement. So basically there are two reasons and you have to learn this. First is that the relationship of parent with the subsidiary, associate, or joint venture. My relationship, that is the parent's relationship with the subsidiary, associate, or joint venture, is intended to be temporary. That means this is not long term. In your language, what you call is casual. So therefore, this is temporary. And second is there are severe long term restrictions which significantly impair its ability to transfer funds to the parent. That means my associate, my subsidiary, this due to some laws or due to some conditions, they will not be allowed to transfer funds to me. Whatever they earn, they will not be allowed to transfer to me. In such a case, this is called severe long-term restrictions. Please focus on the words. These are very important words that I have made them bold. So if there are severe long-term restrictions which significantly impair its ability to transfer funds to the parent. So either it's casual or there is no money, then we will not be, then it is okay even if we do not if included in a consolidated financial statements. Okay, now the difference, now there is not differences, sorry, that means what ASs are covered and what Ind AS are covered. So for this purpose, so your 21 talks about consolidated financial statements, 23 talks about accounting for investment in associates, and 27 talks about financial reporting of interest in your joint venture. So in your AS, these are your three standards included, that is 21, 23, and 27. While for Ind AS, there are four standards. So as you know, 103 and 110, this is your business combination and consolidated financial statements, also called as CFS. And this is also called as BC. Okay, now 28 is investment in associates and joint venture, and 111 is your joint arrangement. So your Ind AS has 4 and your AS has 3. Okay, so I have not made any key for this, but I will still show it over here. Reasons for exclusion of subsidiary, associate, or joint venture. Why you are excluding someone. So either relationship is temporary, that means in your language it is casual, or there are any long-term restrictions to impair ability to transfer of fund. That means you will not get any money. So in such a case, you will not CFS. Any then next is your permanent consolidation adjustment. This we will be doing right now. Oh, this also does not have key. So there are basically two types of permanent consolidation adjustments. One is determination of goodwill and capital reserve. If you know, this is already done. This is only done once. Therefore, it is a permanent consolidation adjustments, and determination of equity attributable to your non-controlling interest. So that is your goodwill or capital reserve or equity attributable to your NCI. These are your permanent consolidation adjustments. Let's read it over here also once again. There's no problem. So there are two adjustments. These are done only on first occasion on or when the shareholding changes. So determination of goodwill or capital reserve, and second is equity attributable to your non-controlling interest or to your minority interest, that is your MI or your NCI. Okay, now auditor to what shall the auditor do? Auditor to pay attention to determination of your pre-acquisition reserves, because your pre-acquisition reserves will be adjusted against your cost of investment. Okay, so pay attention to the determination of pre-acquisition reserves. Next, examine whether pre-acquisition reserves have been allocated appropriately between the parent and the MI or NCI. That means the proper bifurcation is done or not. Next, these pre-acquisition reserves are basically before acquiring, before I purchased you, all the reserves that you had on that date before I purchased you, these are your pre-acquisition reserves. Verify that changes that might have taken place due to subsequent acquisition of shares, disposal in the component in subsequent year. You have to check if there are any changes that have taken place due to subsequent acquisition of shares or disposal in the component in the subsequent year. So these three things the auditor has to check. It may happen that there is goodwill in one subsidiary and capital reserve in another subsidiary. Okay, so in one subsidy there's goodwill, in another subsidy there's capital reserve. So the doubt comes that, boss, can I net off these or do I have to show them separately? So parent may choose to show netted off amount in CFS. Auditor to ensure that gross amount has been disclosed in notes. So if in the consolidated financial statement, if you are netting off, if you are netting of the debit and credit effect, then this has to be shown in the disclosures as gross amount. That, boss, this subsidiary had debit balance, this subsidiary has credit balance, one is goodwill, one is capital reserve, and therefore we have netted and shown this figure. This has to be shown in your disclosure. Okay, so let's check if I made a key for this part also. So permanent consolidation adjustments, the auditor has to check. What does the auditor have to check? First is determination of pre-acquisition reserve, whether they have been calculated correctly. Second is your allocation of pre-acquisition reserves between your parent and NCI. And third is any changes in shareholding, either acquisition or disposal. So these are the three things that the auditor has to check. Okay, now coming to your next part, that is your current period consolidation adjustments. What did we do right now? We did permanent consolidation adjustments. Now we are doing current period. So adjustments that are made in the accounting period for which consolidation of financial statements is done. What you understand that this is done every year. These adjustments include your intra-group interest paid. Intra-group means within the group, that is within a group of companies. For example, there are 5 companies. If they are paying interest to each other, these are your intra-group interest paid and received, or management fees, etc. So all of these are eliminated because this is just shifting money from one pocket to another pocket. Next, unrealized intra-group profits on asset. If one component sold any asset to another component at a profit, so this profit also has to be eliminated. So unrealized intra-group profits on assets acquired, transferred from or to other subsidiaries. So this has to be eliminated. Third, record deferred taxes on unrealized intercompany profit elimination. That is as per your Ind AS 12. I've never liked that Ind AS, so I will not be able to explain you in very depth. Next is your intra-group indebtedness. Intra-group, that means within the group. So if I have lent a loan to someone, this loan will be cancelled in your consolidated financial statements. Harmonizing different accounting policies being followed by the parent and component. Both of us will be following different policies, so we have to adjust so that one CFS that we make, it has only one accounting policy. Adjustments to the financial statements for recognized subsequent events. So any subsequent events that are after the balance sheet date but before the financial statements are submitted, in such a case, any event which require any adjustment to be done, whether those adjustments are done to the financial statement, that is your current period consolidation. Next, in case of a foreign component, adjustments to convert the component's audited financial statements prepared under the component's local gap to the gap under which the CFS are prepared. That means they would be following another gap, and we, for the purpose of CFS, would be following another gap. So we have to convert their gap to our gap. Next, determination of movement and equity attributable to MI or NCI, that is your minority interest or your non-controlling interest in. And another thing is in Ind AS, as per Ind AS, your NCI can have a negative balance. Okay, I know you, now you would be knowing, but as under AS, under accounting standard, this was not allowed. NCI cannot have negative balance. Maximum that they can reach to is zero. But under your Ind AS, NCI can also have negative balance. Okay, so let's see what key we have made for your current period adjustments. For current period consolidation adjustments, our key is M Siddhi IC. M Siddhi IC is Met Siddhi in Candolim. Okay, so whatever letters I have made bold, those are part of our key. So Met Siddhi in Candolim. Candolim is a beach in Goa. Okay, so you met Siddhi in Candolim, therefore it is related to B. So your M is movement in equity. Your S is Your S is subsequent event adjustments. I is intragroup indebtedness. D is deferred taxes on unrealized profit elimination. H stands for harmonizing accounting policies. Your I stands for unrealized intragroup profits on assets, and C stands for convert to CFS gap your foreign component. That means your foreign component gap has to be converted to your CFS gap. Okay. Met Siddhi, yeah, and your I is intragroup interest paid and received. So this I should actually come here. That is I met Siddhi in Candolim. Okay, so that is your intragroup interest paid and received. These are your current period consolidation adjustments. How do you remember current period? So Siddhi is a very happy to go lucky girl. She is very happy. She stays in the current. Okay, so this is your current period consolidation adjustment. You met Siddhi in Candolim. So met Siddhi in Candolim are your current period consolidation adjustments. Okay. Now, of course, over here we will have another current period consolidation adjustments. What the auditor has to check. So there are adjustments required for preparation of CFS are made in memorandum. The auditor should review the memorandum records to verify the adjustment entries, and the auditor should also verify that there are something that the auditor shall verify. So first is any intragroup transactions and the account balances have been eliminated. CFS have been prepared using uniform accounting policies. If you see, these are very similar points to the above. That means all are points of current period consolidation adjustments that the auditor is checking. Next, adequate disclosures have been made as per AS 21 in the CFS of application of different accounting policies in case it was difficult or it was impracticable to harmonize them. That means both these components are using different accounting policies and it is becoming very difficult. It is not practical to bring them both to a common accounting policy. In such a case, you will have to give a disclosure that boss, I have consolidated both of these, but both of these follow different accounting policies. Adjustments made to harmonize different accounting policies to convert a component's financial statements prepared under the components gap to the gap under which the CFS are prepared. This point also we have done above. Calculation of your minority interest or your non-controlling interest. Adjustments relating to deferred tax arising out of elimination of profit resulting from intergroup transaction. That this should not be intergroup, this should be intragroup transactions where the parents accounts are maintained in your Ind AS. Income and expenses of the subsidiary are included in CFS from the date it gains controls until the date it ceases control. That means only and only for that portion should be included, otherwise nothing else should be included. Also check for impairment loss. You should also check for impairment loss on goodwill arising on consolidation. This has to be tested every year. Next point, if the component financial date, if the component financial statement date is different than that of parent, in such a case, adjustment should be made. Adjustment should be made for the effect of significant transactions that occur between the components and parents balance sheet date. So any significant transaction that has occurred between them, that adjustment will have to be made. Difference between reporting dates should not be more than, that means maximum 6 months in case of financial statements under AS and 3 months under Ind AS. That means if the reporting dates are different, it can be maximum 6 months apart in case of your AS and maximum 3 months apart in case of Ind AS. Okay, so let's see the key that we've made. So the key that we've made, what auditor should check is a muddy island. Your beach is nothing but a muddy island. A, muddy, and I. All of these are your points. So A is adjustments to harmonize different accounting policies. Next, M is your MI or NCI. U is your uniform accounting policies. D is disclosure for different accounting policies. Then D is deferred tax adjustment. I is intra-group transactions have been eliminated. And your last I is income and expense included in CFS of subsidiary. From the date it gains control to the date it ceases controls. I hope you are trying to memorize it as you are watching this video. Otherwise, there is no point of watching this video. Okay, so pause the video, play the video multiple times, play it while you are sleeping, and these notes will be emailed to you if you are watching this during the exam. This will be emailed to you immediately within half an hour of order placement. So do not worry about that. Perfect. Okay. Now your auditor should examine the notes required by applicable standards necessary for presenting a true and fair view of the CFS have been included. And he should examine that additional statutory information disclosed in the separate financial statements of the subsidiary or the parent having bearing on the true and fair view of the CFS have been disclosed in the CFS as well. What you want to read it again? Examine that the additional statutory information, that means statutory information which is not required but we are giving, disclosed in the separate financial statement, that is something that has been disclosed in SFS of the subsidiary, which has a bearing on the true and fair view of the CFS on the consolidated financial statements. They should also be included in my consolidated financial statements. Next, information not needed to be disclosed in CFS, even if it is disclosed in your separate financial statement. That means there is some information which is given in your SFS. So while consolidation, you still need not put this information in your CFS. So source from which bonus shares are issued, that is capitalization of profits or reserves or from security premium account, this is not required. Disclosure of all unutilized money out of the issue plus where such unutilized funds have been invested. All of this information, remember, need not be disclosed in CFS. Disclosure required under MSME Development Act 2006, that is your micro, small and medium enterprises. A statement of investments with names in whose shares or debentures investments have been made, that is where the standalone financial statements have invested their money. This need not be shown in your CFS. Value of imports, that is your on CIF basis. So value of imports on CIF basis by the company during the financial year in respect of raw material, components and spare parts and capital goods, these information not required. Expenditure in foreign currency on royalty, know-how, professional and consultation fees, etc. not required. Amount of dividend remitted during the year in foreign currency. This might be shown in SFS but not required in CFS. That is dividend remitted outside India. Yes, that is in foreign currency. Earnings in foreign exchange classified under the following heads, namely export of goods calculated on FOB basis. Remember, over here it is FOB basis, over here it is CIF basis. FOB is your free on board. B, royalty, know-how, professional consultation fees. C, interest and dividend. And D is other income indicating the nature. So earnings in foreign exchange also you do not have to show. Dividend paid in foreign currency also you need not show. Okay, so I made a key for this information not needed to be shown. So your key for this part is BUM IVDFE. Okay, BUM IVDFE, that is beaches usually make ideal vacation destination for everyone. Beaches usually make ideal vacation destination for everyone. So that is B for bonus shares, U for unutilized issue money disclosure, MSME disclosure, investment details, value of imports, foreign currency expenditure on royalty, etc., dividend remitted in foreign currency, and earnings in foreign exchange. This need not be shown. So beaches usually make ideal vacation destination for everyone. Beaches usually make ideal vacation destination for everyone. Okay, so these are your 8 points. Beaches usually make ideal vacation destination for everyone. So your vacation destination, you need not put a story on Instagram. You need not disclose it to everybody. So information not needed to be disclosed in your CFS. Okay, you need not disclose this to everyone because beaches usually make ideal vacation destination for everyone. Okay, now we are finishing this chapter, so don't worry. Just the last part, then you can do whatever you are doing. That is your management representation. That is SA 580 requires auditor to take written representation from management. That is the parent's management, acknowledging its responsibility. That is the parent should understand. The parent should acknowledge. They should accept that yes, it is my responsibility for the true and fair presentation of CFS. Auditor also takes representations on matters material to CFS like first is your completeness of components included in CFS, that is whether all information has been included and whether all my components have been included or not. Identification of reportable segments for segment reporting. Identification of related parties and related party transactions. And last is your appropriateness and completeness of permanent and current period consolidation adjustment. These are your management representation. Coming to your last part of the chapter, that is with regards to reporting. So in such a case, the auditor shall, while preparing report, consider again your essay 700, 705, 706. These three are all relating to opinion, and 600 is using work of another auditor. So there are different cases. That means when parents auditor is not the components auditor, because when you are consolidating your financial statement, you have to use your other component financial statement also. So when the parents auditor, that means if I am consolidating these financial statements, I am the parent auditor, while whose branches or different statement that I'm going to consolidate, their component auditor is also me. So parents auditor is equal to components auditor. That means I audit the parent as well, I audit the component as well. So we are the same auditor. If your component financial statement accounting framework, if the framework is different, if the components over here, the auditor is same. Over here, the framework is different. That is, one might be following AS, one might be following Ind AS. So the framework is different between the component and parent. Next is parents auditor is not the components auditor. So parents auditor and components auditor are different people. Components reporting auditing framework. Remember over here, this is your accounting framework. Over here, this is your auditing framework. So if your auditing framework is different, and last is if the component was not audited at all, the component has never been audited. Your component was not audited. Only in such a case, how will you consolidate the financial statements? So if your parent's auditor is your component's auditor, auditor to report whether principles and procedures for preparation and presentation of CFS as stated in accounting standards have been followed. An auditor to express an opinion whether the CFS, including your cash flow, give a true and fair view of the state of affairs of the group, because your CFS represents the whole group. Therefore, you have to check whether it gives a true and fair view of the state of affairs of the group. Next is the component accounting framework is different than parent. If the framework is different than parent, in such a case, your components audited financial statements converted to the framework under which the CFS is being prepared. That means if the framework is different of the component, you will convert the component balance sheet, you will convert the components financial statements into your framework which you are following under CFS. The conversion adjustments are audited by the principal auditor. These adjustments need to be checked whether they have been done correctly. Else, component may prepare financial statements as per group accounting policy. So there is another group accounting policy. So otherwise, the component may prepare as per the group accounting policies. An auditor shall perform procedures to determine the compliance of group accounting policies with the gap applicable to the parent financial statement. So if the component has made using the group accounting policy, what you have to check now that the group accounting policies, whether the group accounting policies, if they comply with the gap that is applicable to the parent financial statement. Okay, last part, this is done, nothing else is remaining. This is your, if your parent's auditor is not the component's auditor, so auditor to consider requirement of SA 600, of course, because since the auditors are different, you will have to use work of another auditor. Then as per SA 706, auditor to disclose the magnitude of portion of financial statements audited by other auditors. So either in rupees or percentage. That means when you make the CFS, you can say that boss, 30% of this CFS has not been done by me. It is audited by your components. It is not my responsibility. Therefore, you can state this as per SA 706. The fact that part of the audit of the group was made by other auditors is not to be construed as a qualification of opinion, but rather as an indication of divided responsibilities, because your principal auditor will only be responsible for his part. The rest 30% will be the components auditor's responsibility. So this is the division of responsibility between the auditors of the parents and the subsidiaries. Okay, so what they're trying to say that this is not a qualification of opinion. This is just a indication that boss, it has been done differently. Components auditing framework is not as same as parent. The auditing framework, what over here we did was accounting framework. Now we are doing auditing framework. So normally audit of financial statements are prepared under the auditing standards generally accepted in India, that is called as Indian gas. This is not the gas that you are thinking. Okay, so these are these are your general accepted audit standards. To maintain consistency of the auditing framework and to enable the parent auditor to rely and refer to the other auditor's report in their audit report, the component financial statement should be audited under a framework that corresponds to the Indian gas. That also has to be audited as per your Indian gas or another framework which is very similar to the Indian gas. And coming to the last part, I know you do not like this chapter, but I hope I made this chapter easier for you. Last part is your components not audited. That means the component that you are now consolidating, that was the financial statements were never audited itself. So generally, financial statements of all components shall be audited. This is generally. However, if they are not audited, the auditor reporting on the CFS should consider unaudited components in evaluating possible modification of his report. That means if the component is not audited, he can modify his report as he has not been able to obtain sufficient and appropriate audit evidence in relation to such consolidated amounts and balances. Auditors shall evaluate both qualitative and quantitative factors on the possible effects of such amounts remaining unaudited when reporting on the CFS using the guidance as provided in SA 705. So he may, based on his professional judgment, he may give a modification of opinion. Okay, and with this we are done with the chapter. These are all your keys that I will be uploading on the Telegram channel. So if you are watching this video late, don't worry, you'll already find these on the Telegram channel. And we are done with this chapter, and I'll see you in the next one.